MSME Loans, DMI Finance. Pankaj Murpani, Chief Business Officer, SME, Cholamandalam Finance. Ankit Jain, Co-founder and CEO, StepChange. Shinchiro Imahori-san, Deputy Chief Representative of JBIC in New Delhi. Shri Vivek Sen, India Director, Climate Policy Initiative. He'll be moderating the session. Vivek. Vivek, mic is yours. The floor is yours.
Thank you so much. And what a great way to get into the session too. I mean, we heard some brilliant minds speaking in the earlier session. And now this session is about getting deep into the climate risk affecting the credit side or the lenders. So I'll just take 2 minutes to give a brief context, and how we will run this panel is that I will pass on to each one of them for their initial 5 minutes remark. And after that, there would be questions to them. And if then we are left with 5 minutes, then we'll open up to the audience for a few questions. So climate risk is manifesting into the lending, and how? Physical risk is causing increased default, problem in managing the cash flows. There is increased insurance costs. And the transition risk is causing assets to get stranded, whereas also increase in the credit risk. We have a panel where we have international lender in form of JBIC, and then DMI, who works at the grassroots level, or I should say the end consumer level, plus a couple of other NBFCs, Chola, and so we will have a perspective from them on what do they think about how climate change is affecting their lending decisions. So over to you, gentlemen. Imahori, if I may ask you to please go first.
Yep. Thank you very much, Vivek-san, and thank you for having me and the opportunity to have a panel together with prestigious speakers. And Imahori, I'm Imahori from Japan Bank for International Corporation. And the JBIC is a kind of DFI, Development Financial Institution, like US DFC from US, and Korean Exim from Korea, and NAVFID from India. So the JBIC has a special right to access to Japanese governmental foreign exchange reserve. That's why our cost of funds are really competitive. And we are leveraging this cost of finance to contribute in India's green finance. And from the JBIC's the climate credit risk perspective, JBIC set ESG policy in 2021. And in this ESG policy, we set 3 targets. The first is 2050 net to zero. So we have to achieve a net to zero by 2050 in terms of our portfolios, including investment, equity investment, and also debt side. And the second is we have to disclose our financial information under TCFD mechanism, Task Force on Climate-Related Financial Disclosure. And the third point is we are now aiming to expand our climate-related finance, especially in India. And from the climate-related risk perspective, we see this risk is a forward-looking risk. So we have to focus, we have to have a long-term view that can cover a lot of scenarios. So we are doing a scenario analysis. And from JBIC's perspective, our most significant areas, 4 sectors. The first is power, and the second is energy, including LNG, hydrocarbon-related finance asset, and transportation, and also steel manufacturing. Among this, the power, especially for coal-fired power plant, we have 6% in our total outstanding, which is 600 billion Indian rupee equivalent. But now that we suspend our coal-fired related finance, if this plant doesn't have a carbon reduction measure, and now we expect this coal-fired related outstanding will be zero in 2040, in early 2040. But we're still supporting the gas-related finance. We financed city gas distribution in 2022. So we are really keen on supporting, of course, India's hydrocarbon-related projects. Japan also using the coal-fired and also gas as a base load fuel. So the energy mix is quite similar between Japan and India. So we have a lot of collaboration space. Yep.
Thank you so much, and it's great to know that one of the largest or biggest supporters of India in terms of lending low-cost capital is having an ESG policy. So Arindam, if I may come to you, you work at the grassroots level. You operate a digital lending platform which does retail loans. So how is the climate change changing the perspective of your organization, and what are the things you would want to say today?
Thank you so much, and thank you everybody. Good afternoon to all of you as participants today. So this topic is, when initially, Raman had reached out and FIDC spoke about this topic, that would we like to speak about it. So something is building on. Every day I've been thinking about this topic, and every day and every hour it is hitting you that there are certain things which are happening at a macro level, and there are certain things which are happening at a very micro level, what I'm trying to say. And then there are, unfortunately, personal biases because of the city we live in that is creeping in. I will like to keep my personal biases out of it, of what we think about climate crisis of various kinds, whether it is born out of natural disadvantages of India, certain cities, but let's keep those out. So at a macro and a micro level, I would like to talk about few points, what we think is, so at one level, we know there are irreversible damages which are happening. And since we started in the lending world, which is close to about 25 years back, the challenge is very different. We never used to bother about what we are financing, what is the total greenhouse gases we are emitting, what is carbon footprint. We never used to bother. Somewhere around, I believe in 2008, 9, 10, people started talking about it. And today, it is very often discussed, but we don't still do enough. For example, think about it. If you were to build a business which requires a certain amount of customer interaction, which are happening through a paper, which are happening through a physical interaction, versus something which is completely virtual and paperless and does not need any presence of a customer. Which one do you prefer? I'm sure you have the answer, right? Which one would you prefer? Notwithstanding the risk is compromised, notwithstanding the customer experience is compromised. We know all the stories about how the online world has changed in the e-commerce sector. In the lending world, there are many players, including likes of DMI, which we are trying our bit to reduce the carbon footprint. By how? Like, we have given or underwritten loans to close to 120 to 125 million customers over the last 8 years. And we have disbursed loans to about 20 million customers without printing papers. I come from the world of Citi. I used to work with Citigroup in my formative years, where everything was focused on branches. A customer was expected to come to a branch, printing all the documents, or we used to print hundreds of documents to give him a loan of 75,000 rupees or 50,000 rupees. We expect the customer, sometimes I remember in the branches seeing he and his wife, sometimes they used to come even with their children because they didn't have anybody to take care of the children when they were alone at home. So 4 of them, family members in a scooter or a car, coming to the branch, finding a parking place and interacting with you for an hour or hour and a half, then they used to get a loan. these are the old days of city. If nothing like that is happening, no paper, no interaction like this, you automatically know what you are doing. You're trying to give a better experience to the customer. At the same time, you are saving. So this is at a very micro level, right? What as a lender we are trying to do to create an impact. But at a macro level, all of us as lenders, as borrowers ourselves, because we are an NBFC, we borrow money from banks and funds, and at the customer level, right? All of us are customers to an extent, whether we have credit card, whether we have home loan. When you think about it, how rapidly all this has changed, and we were just discussing, Nitin, it is very interesting work they are doing. And think about it from a macro level. If you are modeling something, now your credit models are taking in factors of segments, segment-specific defaults, segment-specific income, segment-specific employment. We are all the time, who are people like us in the credit industry or people like from the risk industry, all the time we are talking about these factors. But increasingly we are realizing that as lenders, we are subjected to suddenly particular city. Let's say we are operating in 500 city and towns in India or 1,000 city and town in India. 4 cities, 5 cities, 6 cities during the peak of monsoon or during unseasonal rains during the last quarter of the calendar year, or now as we enter the extreme summer, especially in the north part of India and the central part of India, we see disruption of businesses at the customer's end. Micro and small business owners who have shops, who have retail outlets, they have to shut shop for X number of hours in each day or in each week, sometimes planned and sometimes unplanned. And typically at the end, the cash flows are affected. When those cash flows are affected, lenders like us get affected from a risk perspective. Our collection mechanism, I'm sure there are lenders in this panel, and some of you probably understand this very well. Your cash flows are affected because you cannot reach out to those customers as effectively as you were doing. Now, sometimes we dismiss these incidences as that, oh, this is cost of doing business, right? If you're doing business in India, which is like 10, 20 different countries put together, so many regions, this is cost of business. But if you start putting these factors into a model, then you start realizing that we are so ill prepared. Now, there are companies like StepEarth, and there may be certain other global companies which are going to give certain information on the private basis that these are the 5 states where we are confidence of 90% or confidence interval of 80%, we can predict that these will be the most affected when there is a monsoon. So now you as a lender, whether you are a bank or whether you are a lender to the end customer, you have to factor these in your model, that whether you should decrease your lending, whether you should change your strategy of lending. So those are the things which we as lenders have to wake up. Whether we like it or not, we have to start talking about it. We have to start discussing this in our, including right up to the board, that this is what is going to pan out over this year, next 2 years and 3 years and 5 years. And what is the alternate, right? Then you come to more tactical things, which is what products you will select to finance, right? Like for example, some of us have been lending to ICE companies, which is internal combustion engines, the popular ones. Do we take a conscious call saying that 20% of our vehicle finance, whether it is 2-wheeler, 3-wheeler, 4-wheeler, we should do only in EVs? Yes or no? That call in the strategy meeting, management meeting, and the board has to take those calls. If you want to take a call on, let's say for example, banks are already taking those calls, that what kind of ESG they will support. For example, recently I think I was seeing some report, global banks, Bank of America, Citi, Barclays, they already have these global charter of going to a net zero number, like our panelists mentioned, 2030, 2050. They're talking about net zero. And they will stop funding people who are extremely high on carbon emissions, including mining, below the ground mining, and people who are into fossil fuel businesses like petrochemical. India, we have not yet taken very hard stance on we have not put the stakes on the ground, but probably certain public sector banks and private sector banks already coming out with these charters. So whether we like it or not, it will affect the business, it will affect your cash flows, it will affect our disbursal, it will affect our top line and hence the bottom line. But it is better to be prepared, and your charter has to be done now in 2025 rather than any more delay. So that's what at a larger level we are all awakening to the realities of doing this business. And a little bit of, he was also talking about a very interesting, I don't want to steal his thunder.
Arindam, if you can wrap up in a minute because we have a paucity of time. So.
Okay. So he was talking about that what is a lead effect and a lagged effect. In our businesses, we are very cognizant about lead and lagged effect. But if somebody tells you something you are going to do in 2025 because it will affect you in 2030 and 2035, then eyes will roll, lot of heads will roll, and there is no easy answer. With that, I would like to conclude.
I'll straight away go to Pankaj for his opening remarks.
Good afternoon to everyone, and thank you for giving this opportunity. So I come from a NBFC, Cholamandam, wherein, as like Arindam was mentioning, we are into a traditional business in last, say, 50 to 60 years, and we reach out to the customers, underserved, or we reach out, our spread in the market, like say with close to some 1,800 to 2,000 branches, we reach out to the customers who are not served to the requirement. Those are not bank customers. So we are playing a role as an NBFC to serve them. And of course, our model would be more of phygital. It's not completely digital. We have a physical reach, understanding the customer, understand the dynamics. And it's on the, when it comes to paperwork and all, it is all digital. So we call it phygital kind of a work, what we do. It's not only, and we finance all the vehicles, solars, wherever there's a requirement. So we are getting into that shape. At the same time, earlier the risk used to be very clear, like it used to be traditional risk assessment model on the customer or the product which you are funding. But now with this climate risk which are happening, which are there, a lot of dynamics have changed. You cannot have the same traditional model of doing the risk assessment of the customer, his cash flows and all. But it is more to do with the climate and the geographies where they are, which we have to keep into consideration. We keep that and we are developing that method, but at the same time, what is required to assess a customer? If in the new age or in this, keeping these risks in mind, if we have to assess a customer, there has to be a climate stress test kind of a thing which you have to internally develop. And then there has to be data and analytics, which is required. And I am sure there are a lot of participants, I think Ankit will talk about it a little bit on that, how historically they are taking the data to take decision or the call on the customer, which is required, very much required in current scenario with the fast changing world, and in fact, Indian dynamics are also changing very fast. So we have to have some scientific method instead of just having a traditional approach. We should have some data and analytics and models by which you can take a call. We have to grow, everyone has to grow, we have to serve to the customer, every business has to grow every year, and India is a fast developing country, we have to contribute, and as an NBFC, we will always be there to do that. But how? That is the question. And then comes a lot of other questions. Before this panel discussion, we were hearing about what should be the cost of fund, whether this is the right cost, that is the right cost. So that is one aspect of lending. At the same time, reaching out to the customer is another aspect which NBFCs generally, they are doing it, and we have been doing it for quite large. But this is the area wherein we have to think about it, we have to really go about it, and of course we have to support the green products, which basically be it EV two-wheeler, three-wheeler, last mile connectivity, solar. There are a lot of products which are coming, and adoption is going up very fast. If you go to some of the states, be it Tamil Nadu, be it UP, a lot of states, adoption of EV has increased significantly. So we have to gradually go, and that is our mission. Government is also driving for the EV drive. So that has to come, which all of us have to support. We have to brainstorm, we have to deliberate on what are the steps we are, and how we are going to contribute, be it financer, be it a risk agency, be it the data analytics team, or other agencies, how we are going to address this. So broadly, I feel with that, we will come to the other points, but this is broadly, I feel that how we will play our role to reach out to the customer and how effectively, efficiently we do it for our own self as a company and for the customer. Yeah, with that, thank you.
Thank you so much. And Ankit, you work with data and you also work with RBI. So if you can focus your initial remarks around that.
Sure. I'll just spend a few minutes introducing what is it that we do for the audience's benefit. So I run this company called StepChange. We are a climate tech platform. We essentially think of ourselves as a climate and sustainability decision-making company. Right, so while there are a lot of providers who will help you put together sustainability reports and compute scope 1, scope 2, we really think of ourselves as somebody who can help you make better decisions on which loan to give, not to give, what interest rate to charge, how much risk is there in something, which value chain partner to work with, how do you measure scope 3, how do you use that for decision making, really as how do you start bringing climate and sustainability into your day-to-day decisions, right? So we want to hold ourselves to a bar that the data, the tools that we build are decision grade, right? They're not just compliance grade, they're not just risk grade, they're truly decision grade. And in that context, we primarily have two types of offerings. We do what is called operational sustainability, where we largely work with real economy companies on measuring sustainability in their own operations, understanding climate risk in their operations, in their logistics networks, in their value chains. And, but the bigger part of our business is around portfolio sustainability, where today we work with almost, I would say, 8 out of the top 10 banks in India. We've measured financed emissions or climate risk for almost $1 trillion worth of Indian assets. And the total amount of emissions we have computed is about, and this is just in a year, about 650, 700 million tons. To put that in context, that's larger than UK or France as an economy. That's about 20, 25% of India's emissions, right? So with that type of data, we have a reasonably good understanding of what's really happening with sustainability and to some extent with climate risk in India. Now, two things I wanted to call out specifically given the focus today on NBFCs. So some of you would be aware there have been BRSR reports that have been published for the last few years. If you add up scope 1 and scope 2 data, so just for everyone, greenhouse gas emissions have scope 1, scope 2, scope 3. Scope 1 is whatever you do within your own premises. So any burning that you do, any fugitive emissions. Scope 2 is typically electricity consumption. So scope 1, scope 2, which is direct control. If you add that up for the top 1,000 listed companies in India, which has all the power companies or most of the power companies, it has most of the coal, cement, all the hard to abate sectors are sitting in those 1,000 companies. It's not even 40% of India's emissions. So majority of India's emissions as a country is not sitting in large listed entities. It is sitting in SMEs, it is sitting in value chain, it is sitting in our agriculture, it is sitting in the vehicles that we have. And a lot of that economic activity is driven through NBFC lending. Right? So majority of our emissions today, so our impact on the environment is in some way or the other getting financed, at least in part, through NBFCs. But also on the other side, when you think about climate risk, if you think about a climate risk or a physical climate risk specifically to a large listed entity, they have sufficient cash holdings, they have sufficient buffers, right? A flood is not going to take down a top 100 company in India. But a flood that closes the shopkeeper's shop for 15 to 30 days is enough to eat up all the profit they would have made that year. Right? So in that sense, and I'm simplifying this, of course, right? Every situation is unique. The physical risk, and to some extent even the transition risk, is much higher in the segments that NBFCs serve than the segments that banks tend to serve or the large corporate segments that exist. Right? So I just wanted to call those as things, and hence how important sustainability and climate risk needs to be in decision making for NBFCs. Now, just should I move to the data and RBI?
Yeah, I'll come back to you, okay. But you can take a minute to explain what you are doing with RBI.
Sure. So we've been quite involved with both regulators, RBI and SEBI, for a few years. So I personally sit on the SEBI ESG advisory committee around the disclosure requirements in India. And my co-founder is involved to some extent with RBI and the climate risk information system that RBI is putting together. And we had written a concept note, which I have with me, on what type of data, methodologies, systems do we need that only a regulator can bring together, because a lot of different type of data has to come together. And so if you think about climate risk, there are fundamentally 3 types of data that I believe have to come together, right? One is asset data. Where is an asset and the attributes of that asset? Climate data, which is meteorological data, which is forecasts. And then loss data or damage data, which is historical data. When a flood of certain magnitude happened in this city in this year, what type of damage did it do to vehicles versus farms versus these types of crops versus this type of home, etc. Because that's what you need to model future risks. That bringing all of those types of data sets together so you can do this modeling, only a regulator or someone like that can bring that together. Well, I'll talk about what we are doing in that space a bit more later, but that's the work we are doing with RBI.
Thank you so much. And I should begin with you because you spoke about a very interesting thing called data. We ourselves have tried mapping some data to measure climate-related physical and physical risk, basically, on 4 or 5 important sectors in the economy. Now, what we established was that the data is fragmented, low quality, and at the most, there is no availability of data. I mean, meteorological data is not at all in reach of any of the private players. It is sitting with one agency which deals only with the government. So what do you think can government of India do to make availability of data more in the ecosystem so that organizations like you and others can play with it and can probably work upon their risk rating frameworks?
Got it. Let me break this problem into a few parts. One is data which is fundamentally not collected today. Second is a lot of data that is collected by the government but doesn't talk to each other, is not available. And third, data that is collected but sits with private entities. And the answer is slightly different for all of them. Right? I'll start with the middle one first. Today, there's a lot of data that is collected by the GST department, by the Pollution Control Board, by Bharat Bill Pay, by Shops and Establishment Act, and like the state level, center level, multiple things that SMEs, companies of all types are already providing. There is no single place where all that data is available in a sandbox that you can bring together and quickly put together a profile of a company and what they do. Right. Now, we've solved things like this before, right? Whether it was the account aggregator framework or other such sort of digital public infrastructure platforms, where through the right ecosystem partnerships, you can put together an open platform with the right privacy, right security in place. So different types of data sets can be brought in and made available to people who need to use that. The third one also partly gets addressed with this, right? So today, in order for us to get high quality asset data, right? So for example, the impact that a certain type of flood would have on a certain building depends a lot on how that building was built. Like what materials did you use? That data is not sitting with the government anywhere or in any digitized format. That is probably something in the head of the proprietor of that building. So how do you start getting access to that data? Who starts collecting that data? Does it become a requirement when you give a loan to ask some of these details? Does it become a requirement when you're insuring that building to start collecting that data? But we have a good sense of what type of data needs to be collected that feeds into climate models that are prevalent today. So that type of data needs to become a requirement, almost like a, let's call it some sort of a KYC type requirement, right? You have to collect that data in order to get a certain type of loan. So that's the second one. So we are at least involved in 2 broad efforts to do this. One is the RBI CRIS thing, which anyway the regulator is thinking about. There, the type of data that we are specifically looking at, one is most meteorological data today that is available, historic as well as predictive, is often by at a 1 degree and 1 degree resolution. So give you that perspective, that's latitude, longitude. 1 degree is about 100 kilometers, right? So you're talking about 100 kilometers by 100 kilometers grid, right? If someone gives you weather data at that, that's not really decision grade. There's so many sub-climates that can happen in a 100 by 100, right? In 100, imagine you're of course a lot more flood prone if you have a property right next to a river than if you are 5 kilometers away, right? So you cannot just do climate risk metrics at 1 degree by 1 degree, right? So you have to figure out how to downscale that data, but downscaling introduces errors, right? So hence, not everyone can do this downscaling differently, and then we are comparing apples and oranges. So a regulator or an academic institution should take on the job of figuring out how to provide that data, at least historical data, if not future data, in highly granular format, made available to the public, so people can start building better models based on that. Similarly, the vulnerabilities of different types of asset types to different types of hazards. Right? Now, if there is a drought, exactly how does a farm get affected versus how does a building get affected are very different. Right? And a crop of certain type is affected differently than a crop of another type, right? So and in India, those impacts will be very different, where we are, let's say, monsoon dependent on agriculture, versus in Europe, where you have sufficient irrigation available, right? So we need to have India-specific indexation of different types of risks on different types of hazards. Right. So I literally have a list of like 40 things we had asked RBI, but you have to go down to that level of granularity and say, here are 40, 50 different types of data sets that we need really to do this well.
Right.
5 of them might come from the government or RBI, but a lot of others have to be built, right? And that is where private-public partnerships are needed.
Thank you so much, and I really wish that can happen soon. Pankaj, Chola is a fairly large NBFC and has a very good portfolio, especially in the south. What have you done to accommodate climate risk into your risk rating frameworks? How are you handling that?
Actually, our distribution of portfolio is pan-India. So all the 4 zones for us, be it east, south, west or north, we are equally distributed in terms of our portfolio. When it comes to the risk assessment, so as I was mentioning earlier also, like earlier it used to be mainly on the risk assessment traditional models. But now with this climate risk which are evolved, and we have little bit of data and we have experience on that. So we decide basically the stress, few models internally will have like stress test or the data analytics, what we do, that will help us to kind of take a call. And it goes different products also. Be it if we are funding a tractor, your call would be a different versus a car funding or a two-wheeler funding for the personal use. So there are multiple factors which we consider. But however, saying that we have to have, it's more intuitive or more out of experience. But when we'll have more data tools or models which will be available going forward, historical data, and there are a lot of data which are now captured. If that would be available, it will be more effective to kind of take it to the market and go a little more kind of more aggressive or more down the line to the customers. So that's what we are looking at. But at this point of time, it's mainly on that whichever companies, like it's a green rating, if the company or a SME is doing pretty well on the risk, kind of risk which are there, if they are on the transition risk or the physical risk, if they are managing it well, they have their ESG programs well for them, we give it as a positive side, and we obviously the risk decision makings would be different for those companies who are more inclined towards, and they are cognizant of what is going to be there in the future. And that's how we have to take a call. And that's, I believe, that's the reason why we are developing, and going forward also it has to be more robust rather than the traditional call. Yeah.
Thank you. And Arindam, your model is very digitally driven and people-centric, I would say. So the same question, how do you factor in climate-related risk into your risk rating models? And is it anything different from a traditional NBFC who operates on brick and mortar type of a model? How do you deal with this?
Thanks. So we, at this point of time, when we build models, we look at obviously the micros more than the macros, not because of we don't want to use. It is simple that our lending is more towards retail, and these are short duration loans. So the duration and the duration risk is very limited. We don't give long-term loans of 5, 10, 15, 20 years. We give loans of 1 year and 2 year, maximum maybe 3 years. So what happens is the macro factors, which is, let's say, for example, unemployment rates or the employment rate transition in certain states. It affects to an extent, but it is not very pronounced. It is very difficult to model in the credit, the data science model, credit data science model. Similarly, what we are trying to do is we are looking at macro data, for example, let's say the climate, flooding or famine, or because of extreme heat or extreme temperature, how certain states or how certain pockets in that state is getting affected. So we do not have very reliable data, and we probably will need to work very closely with the private sectors, like what Ankit was mentioning, and certain public sector, if the data is there, and start factoring those into our credit model. Because what happens in a credit model is, like, typically you start with a stochastic model and then you eventually get into deterministic. To build all those, it takes time. Because first you have to, once you build it, then you have to test it out. How do you test? Because these are very dynamic situations. It is not as simple as somebody's assessing somebody's income or understanding somebody's segment risk because of employability. Because there is a lot of data on employment and income, but not on this. So we would have to work in very close concert with private sector, public sector, government. Thanks to RBI's initiative, since last 1 year, this entire initiative has brought to the fore, and all of us are supposed to contribute, thanks to Ankit's team, which is contributing over there. So we are looking forward to that kind of granular data, which we will then use. At this point in time, otherwise, simple answer is we don't actively use this for our underwriting models, right?
Thank you so much. And may I please turn to you, Imahori. JBIC is an international bank and it works in various geographies. What do you think about India? How can JBIC help the Indian financial ecosystem become more climate resilient?
Thank you very much. The JBIC is Japanese financial institutions, but when it comes to India's finance, we think we have to collaborate with partner banks, including NBFC. So in January, we executed the credit facility together with Power Finance Corporation, PFC. That was $1 billion equivalent. That was a second GA. And also in 2023, we established India-Japan Fund together with NIIF, National Infrastructure Investment Fund. And also we collaborating with State Bank of India. This is bank, but as I said, the city gas distribution project, we collaborate with SBI. So I don't think the JBIC, of course, has a lot of the direct finance opportunities, such as a hydrogen project, green hydrogen project. We are about to co-finance together with MDBs and also commercial banks. But when it comes to the specific sectors, we see the collaborating with NBFC is important. So we are now discussing with IRFC from railway sectors and also IREDA in the RE sectors. And also private sector-wise, of course, we are discussing with private sector and non-bank as well. So the partnering with Indian banks and non-banks is crucial for us to contribute more and more and expanding our business in here.
Thank you so much. We have around 7 minutes left, and I would like to open this to the audience. Any questions, you may please identify yourself and point it to the person you want to have an answer from. Yeah, there is a hand up there.
Hi, I'm Nishant Idnani from Walters Green Funding. We have an advisory and asset management business funding green assets. And my question is to Ankit and Arindam on some very interesting points you mentioned specifically regarding seeing the climate risks at a more granular level play out, whether it's because of the heat that businesses are closing, or the second one is when you are closer to the river proximity, less than 100 kilometers. I think it's a topic which I feel strongly about as well. But the question is, from a financier perspective or the asset creator perspective, what are the actionable changes these financiers are bringing about? Are we saying that we are going to increase the PD LGD and hence the pricing for all the borrowers as a result by measuring these risks? Or second is, we are going to say no to these people? Or third, are we going to say that please introduce certain actions to fortify your assets? So my question and reaction from both your perspective would be regarding your specific institutions or the conversations which you are having with the banks and financiers.
Okay,
So
Arindam, you go first.
So I'll answer those very interesting parts since you brought in PDLGD and models which you use. In our ECL models at this point of time, it's a formulaic approach. And in the formulaic approach, we do not take, at this point of time, anything to do with the climate risk, not yet. But when we talk to outside consultants, they are continuously telling and figuring out how to factor at least the global macro risk. For example, let's say the country risk, the regulatory risk, the product risk, the market risk, and something which is right now playing out, which we had never even imagined to be at this level it will play out, which is to do with the world of tariffs and how it will upset the global supply chain and how. So we have not yet done. Our models are more internal models which are using segment risk, probability of default because of that particular segment, because of the employment or lack of employment otherwise. And we are in the process of consulting and looking at a slightly broader framework. One challenge in that, and I again calling it out because I just spoke about it some minutes back, that one of the biggest challenge in our world when it is formulaic and it is relying on a lot of data, it has to traverse a certain amount of time, because if you don't, then you start plugging in without understanding, and then you will not be able to defend or say pro or say against anything if somebody challenges it. That why did you take your country risk as X and not as Y, right? So in India, like you said, that or some of us have pointed out that if you are in a coastal area, what are the chances of it getting flooded? What are the chances it is sitting on a earthquake zone? What are the chances that there will be something of some Richter scale of 6 or 7 which will disrupt? And what are the chances of that event occurring in the next 10 years versus 20 years? What is the, sigma 1, sigma 2? Very, very difficult because there is not much of reliable data. And India itself, unlike the West or unlike certain parts like Japan or developed nations, we have very limited data and even less on the climate side, right? So at this point in time, answer is no, but it is a very, very important thing. It doesn't mean that we don't start tinkering around, start asking questions, start gathering the data. Thanks to certain public and private sector collaboration, we would love to figure out an answer. Thanks.
Ankit, your take on this.
Yeah, I'll keep this short. So I would say most financial institutions are yet to start acting on it. Right? They're still understanding the space, they're still building the models, they're still collecting the data. Those that have started acting are often at a policy level where they would say, okay, we will do physical risk measurement, transition risk measurement. If it goes above a certain site, there's an additional due diligence that happens. You get inspection, and this will of course be for larger loans. This will be for certain types of assets. Real estate perhaps is where people start, and so on. There are also some who are starting to tinker with ideas like, okay, for a certain PIN code, for certain crops, we are going to stop doing lending. Right? Certain types of assets in certain places are becoming too risky. We're seeing, of course, a lot of that in domain of insurance in West, where people are walking out of Florida, California, they're not insuring homes, and now, so a version of that is starting to be thought about. There is this concept of, since you talked about PD LGD, climate adjusted PD, climate adjusted LGD. So it's not just that you will increase PD LGD across the board. You will start computing climate adjusted PDs and climate adjusted LGDs on specific loans. Now that is where data has to be decision grade, which is what I was saying earlier. So today, a lot of that data is not decision grade. It is approximate data, it's estimated data. So it'll give you directionally right answers, but not enough which are at the sort of PD, LGD computation levels, because they are so sensitive to assumptions you make. So,
yeah, gentlemen. Can you, someone pass the mic, please? Yeah, you can.
Hello. I'm Ajit, founder Khushigram, and we are working on, we have a social organization as well as we are forming multi-purpose, multi-state cooperative to solve these problems. So all the sustainable development challenges.
Right.
So I'm working with many partners since last 5-6 years now. So developing a paradigm, trying to now implement it. So my question is that when we talk of technology, we always talk of Western technologies. So whatever has come from the West, not what originated from India or what developed in India or what is developing in India. That has taken a backseat. That is one major problem. Like products like Gokrit, Gobar plaster, which cools your buildings and all. Bamboo also we had a lot of bamboo construction. And now I'll tell you, there are some experts, 22nd there is a program you can in Delhi. So there are experts who have created bamboo structures better than China also. China is considered the lead, India is quite way behind. So why don't we try to look at financing these kind of initiatives and products and services which can reduce heat to say 10-15 degrees in summers? Thank you.
I think Arindam, you are most closer to the ground. So, but please keep your answer short because we are already up.
Thank you for the introduction, and it is really impressive to hear somebody is trying to think on those lines and building indigenous products. The country needs it. Whether the lenders need it or I don't know, but the country definitely needs it. Short answer. Unfortunately, we are slightly biased with going through the data. If the data is telling us that this is a better product, it doesn't matter whether it is coming from India, whether it is coming from Germany, or whether it is coming from Israel. We would like to go with it. And second is, we are largely customer-centric. The customer decides the product. We don't. Like, for example, if a customer says that I am buying a phone from Oppo, and versus somebody saying that I like the phone of Samsung, we as a lender cannot create biases that, hey, with a Samsung phone, I will give you a lower LTV or a higher LTV, and a Oppo, I don't like it, we don't. Because then we will play a very different role. And our role is not to influence the product decision. The product decision is always with the customer. For example, if the customer is choosing to buy a home in Delhi in a certain pin code versus another pin code, our role is not to tell him that, hey, why are you buying over here? This is already saturated place, your prices will not increase. That's somebody else's role. So that's our limitation.
Thank you so much. Our time is up, but
I'll send you all data after 30th June. We have collected a lot of research materials and Indian knowledge systems. So I'll send you the data after 30th June. We'll have all the data.
you can connect bilaterally with the speakers. They would be available for lunch, but they are anyways in the room. Thank you, gentlemen. It was a great discussion, and I hope the audience liked it.
Thank you, Vivek, for steering this conversation. May I request Raman Agarwalji to come and pay the gratitudes to the speakers. So they have discussed the integrating climate in the credit risk. Arindam Das, CEO Consumer Credit and MSME Loans, DMI Finance. Pankaj Murpani, Chief Business Officer, SME-Cholamandam Finance Limited. Ankit Jain, Co-founder and CEO at StepChange. Shinchiro Imahori, he is Deputy Chief Representative, JBIC New Delhi. And Moderator, Vivek Jain, India Director, Climate Policy Initiative. Climate Policy Initiative was knowledge partner for this session as well as for the Credit Summit. Thank you, Vivek, and your team.